employees who participate in some form of employee ownership can benefit from both the capital appreciation and the wage growth. And this is one possible way to close the wealth gap between asset owners and workers, which I think obviously has lasting ripple effects throughout the entire community.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
In today's episode, we're exploring employee ownership as a powerful corporate sustainability strategy and one that can help businesses create lasting value for employees, communities, and the next generation of business owners. I'm joined today by my colleague Leah Turnbull, Managing Director and National Employee Stock Ownership Plan, or ESOP, Practice Lead in the US at BMO. Leah will walk us through what employee ownership looks like across North America, why more companies are considering it, and how it can strengthen businesses while aligning ownership with long-term purpose. Welcome to the show, Leah.
Thank you for having me. Glad to be here.
So, Leah, when we say employee ownership, can you tell us what that means in practice and what are the main structures you see most often in the US and in Canada?
There are a few ways that employee ownership could be structured as direct equity, where the employees actually own common shares, stock option plans, so the employees will have a unit that is tied to the equity value of the business, worker cooperatives, or a trust. So for today's conversation, I'll focus mostly on trust and specifically ESOPs, employee stock ownership plans in the US, and employee ownership trust or EOTs in Canada. EOT legislation was passed in 2024 in Canada, so it's still an evolving structure. Whereas ESOP legislation in the US was passed about 50 years ago. So we have a lot more case studies around the impact to individuals and communities. But in both cases of an EOT and an ESOP, the trust is the buyer of the shares, and the employees will have a beneficial interest in the shares. So typically, the individual employee will not put any of their own money into the plan. The transaction is often funded with debt, usually a combination of bank financing, seller financing, or vendor financing, and maybe some form of junior capital in between. And ESOPs are a retirement plan, and generally the employees will receive cash for the value of their shares upon retirement, whereas Canadian EOTs offer most of their benefit in the form of dividends on an annual basis.
So, Leah, can you tell me about how this space has evolved over the years? Is this a growing opportunity, and is it new to the US or Canada?
So in the US, employee ownership and ESOP specifically have been around for about 50 years. In fact, 2026 marks the 50th year that BMO has been supporting employee-owned businesses. The main evolution is that we're seeing larger companies explore employee ownership. And part of that is due to some of the tax savings changes that's happened over the last 30 years. And also the industry as a whole has become a lot more sophisticated and meeting the needs of these employee-owned businesses. In Canada, employee ownership is pretty much brand new. So it started in 2024. The exciting part about Canada is that they were able to take the good of US ESOPs and the good of United Kingdom employee ownership trust and create this hybrid structure. So very excited to see what the future holds in Canada, and also really excited about the future in both countries, given the fact that there are an incredible number of small and medium-sized businesses that are owned by individuals that will retire in the next 5 to 10 years. And many of those businesses have zero ownership transition planning completed, and they need to be able to evaluate what their options are. And employee ownership is one of the options that they should be thinking about. And I just think ownership transition across the board will be a huge topic of conversation over the next decade. And I hope that employee ownership is one of the growing solutions for all those baby boomer business owners.
So, Leah, this podcast is about sustainability, and that topic means a lot of different things to different people. I like to think of it as a way that businesses can create long-term value through positive stakeholder relations. And employees, of course, are very important stakeholders for companies, as are communities in which the businesses operate. Can you tell me your thoughts about ways in which you think employee ownership can support sustainability, particularly around long-term community economic resilience and community and employee relations?
There are studies that show that employees at employee-owned businesses have much stronger financial well-being and are able to manage through different economic cycles. Studies from the Federal Reserve and Economic Policy Institute demonstrate that equity growth in recent years has substantially outpaced wage growth, but only the highest income families actually own equity and assets, and the people without assets have not participated in this growth. So employees who participate in some form of employee ownership can benefit from both the capital appreciation and the wage growth. And this is one possible way to close the wealth gap between asset owners and workers, which I think obviously has lasting ripple effects throughout the entire community. There are also incredible anecdotes of individuals who are able to manage a crisis because they had the financial security from their employee ownership. So one example is of an individual whose baby was born premature. He had unexpected medical expenses. Through a dividend he had received as an employee owner, he was able to pay for those medical expenses and focus on his family and what matters. If he didn't have that ownership, he would have had no way to pay his bills and been dealing with debt for many, many years to come. Instead, he was able to start his child's life with financial security. And that takes such a burden off that family, and it takes such a burden off their ability to focus on what's really important as opposed to only focusing on debt repayment. Another example, there was an employee owner who was homeless and living in his car, and he found a job at an ESOP-owned company. That company invested in him, provided him financial wellness training, and has given him a retirement plan that will allow him to retire with dignity and certainty. And that's free money for him that's set aside from the very beginning. And I think that type of security is something that doesn't exist in a lot of businesses. Most employees in the US, at least, are living paycheck to paycheck. They can't afford to put any money aside for retirement and to invest in their communities. And the employee ownership really gives them that security.
Can you tell me to what extent are the goals of ESOP programs aligned with the objectives of the business owners? What's really in it for them, and why would they be interested in this?
For most business owners that pursue employee ownership, the two words that resonate with them are liquidity. They're ready to diversify their wealth, which obviously they can get liquidity by taking a dividend or selling to a third party. But the second word is legacy. They built this business from the ground up. They really care about their employees and their communities. And they know that if they sold to a third party, things change. The new owner could bring in their own management team or shut down operations, move it to their headquarters. And some of that change may be necessary, but it's also change that can be devastating to the individual workers and to their communities. So I think for all of these situations, from the business owner's perspective, the ones that have really been successful with employee ownership, they care about their employees, they care about their communities. This is their way of building that legacy and maintaining their legacy for generations to come.
So, Leah, when you're helping a business owner decide who should buy my company, how do you frame the pros and cons between these different options you've just outlined? So traditional buyers, internal options like management buyouts, or this kind of ESOP transition of ownership to employees?
The beauty of an ESOP in the US is that you have a lot of flexibility in how the transaction is structured. So a business owner could sell 1% to an ESOP, up to 100% to an ESOP, and anything in between. Whereas a third party, such as a strategic buyer or private equity firm, often, not always, but often once controlled the business. Now that does differ from Canada, where the EOT needs to have operational control or own 50% or more of the business day one. So there's a little bit of difference there, but the flexibility from a business owner's perspective is really different from what they could get from a third party buyer. The other factor, as you're thinking about the menu of options and solutions for ownership transition, is that in the US, there are personal as well as corporate tax savings available to businesses that sell to ESOPs. In Canada, there are personal capital gains tax savings available. I could spend hours going into all the details, so I won't do that for purposes of today's conversation. But just know that on both sides of the border, there are tax savings that do not exist if you sell to a management team or to a third party. And then the other benefit is employee ownership allows the company to stay the course. The company will operate the same post-transaction as it did pre-transaction. Again, as I mentioned before, things change when you sell to a third party. And so a lot of these business owners are not ready for that change. They want to keep providing for their community, keep jobs in their communities. They want to keep their management team in place. They've helped them build it from the ground up, and they want to reward those key employees. And employee ownership is a way to provide for your employees. From the employee's perspective, this is largely free money to them, and that can also be a huge recruiting and retention tool. On the flip side, the ESOP or the EOT is not bringing any new expertise or management to the business. A third-party buyer could offer some of that expertise, which may be the only way to stay competitive in their industry. Separately, this is a leveraged transaction. So you are borrowing and taking on debt to fund a shareholder buyout. And that could limit a company's ability to be nimble in an economic cycle or opportunistic for strategic investments. The key message for any business owner is that you need to have strategic conversations with your advisors to think about all the menu of options, because there's pros and cons to each. And while employee ownership is great, there are considerations that everybody needs to be aware of. And so hopefully taking advantage of that education and getting to know what all alternatives are will help you pick the best path for you personally, your business, and for your employees.
Are there certain types of companies that tend to be stronger candidates for employee ownership? And what would be some of the characteristics of those companies versus ones that maybe are not as well suited?
Ideal candidates are businesses with steady financial performance and a management team that can run the day-to-day operations. Employee ownership is a great ownership transition tool. It is not a management transition tool. Additionally, given the leveraged nature of these transactions, they need to have the financial strength to fund the incremental debt obligations. But from a company perspective, we see employee ownership in all industries across the board. So construction firms, consulting firms, manufacturing, really any business can be a strong employee ownership candidate, but they just need to have that financial strength and stability, as well as the management team, to make sure that they succeed now and in the future. And then on the shareholder side, there is an ideal kind of candidate from a shareholder perspective. One, it's somebody that really cares about the legacy of their business and is willing to receive the value of their shares over time. Many of these transactions require some form of seller note or vendor note, and those notes take years to be fully repaid. There is this perception out there that ESOPs in particular cannot pay fair market value. That isn't true. However, they cannot pay strategic value. They do have a fiduciary obligation to make sure that the ESOP is not overpaying. So in practice, this fiduciary obligation can cause the ESOP to be a more conservative buyer, but it should be largely in line with other buyers. So if I was a business owner, I wouldn't use valuation as the immediate gating factor to why not to pursue employee ownership, but it is something that you would want to explore to make sure you fully understand where valuations are.
Leah, what are some of the common challenges that can pose problems for establishing this type of arrangement, and how would you address them?
Well, the number one constraint to why there aren't more employee-owned businesses across the continent is lack of knowledge. There are too many business owners out there that have never even heard of employee ownership. A study showed that only about 3% of American voters heard a lot about employee ownership, but after they learn about it, 93% of voters support it. So things like this podcast are part of my mission to make sure at least people understand that this is a solution that's out there. And with that lack of knowledge, though, it also brings some of those misnomers. And I have seen advisors immediately dismiss employee ownership only because they don't fully understand it. So I think getting the message out there, making sure people know that this is a very viable solution for businesses, both large and small, is really important. Another big challenge is that, especially in the United States, the flexibility that an ESOP allows for also brings with it complexity. And for some businesses, they may not have the bandwidth to manage that complexity. The good thing about EOTs being new in Canada is that they were able to learn from some of the other existing employee ownership structures. And so the Canadian EOT is a much more simplified structure. Now, the tax savings aren't as large, but also the administration process is much more manageable. And again, it is a leveraged transaction. And so for some businesses, it may not be prudent to put debt on their balance sheet. So for really small businesses or for a business that is cyclical or capital intensive or highly acquisitive, you need to be able to balance the needs of the seller with the needs of the company. And then on the flip side, for larger businesses, some of the challenges with employee ownership and why they may not pursue employee ownership is that they may need more access to capital, specifically more equity. So historically, private equity firms and strategic buyers just eliminated employee ownership instead of finding a solution that allows for equity plus employee ownership. But that is something that I think is evolving and will be changing, hopefully sooner rather than later.
Looking ahead, Leah, how do you see employee ownership evolving over the next few years?
The thing that excites me the most is that employee ownership is one of the very, very few bipartisan topics in DC. The most conservative and the most liberal politician agrees that this is good for business, for the employees, and for their communities. So it's a very easy topic to lobby on behalf of, just given the bipartisan support. And then the other exciting thing is that there is an uptick of new creative legislation being discussed today to make employee ownership a more viable option for both smaller businesses and larger businesses. So one example is a nonprofit ownership works, which has created a shared ownership structure where portfolio companies of private equity firms allocate a percentage of the equity to the employees. While this isn't massive percentages of equity, it still has life-changing impacts to the employees. And separately, there's more interest today than ever in the past to find solutions to make ESOPs in particular more streamlined and easier to administer so companies don't immediately get turned off by the cost of administration. So I just think overall, the excitement and the energy that I have seen in creating novel solutions for employee ownership, it's more than I have seen in the past 20 years since I started working with employee-owned businesses.
Does this create an opportunity for institutional investors or others outside of the company?
Absolutely. And in fact, on top of that, like some of the creative solutions that are coming up, there's a lot of firms out there that are thinking about how do we support employee-owned businesses. It's a supply and demand challenge, right? There needs to be supply of capital in order for the demand to increase, but there also needs to be a demand for that capital to maximize the supply. So I think that's part of the issue is getting the message out there, making sure people understand the power of employee ownership. But these businesses, employee-owned businesses, typically run more profitably, they run more efficiently. From BMO's perspective in particular, the default rate is significantly lower than our non-ESOP portfolio. All these factors from an institutional investor perspective make employee ownership a very attractive investment. And there definitely is a lot of interest into how do we support employee ownership. And again, the issue is that today, a lot of these ideas are just that, ideas. But the fact that these are conversations that were not being had 10, 15 years ago, it's really exciting because I think we're just at the precipice of a lot of change.
And Leah, in terms of the opportunities for BMO, what is the interest that BMO as a North American bank has in this space?
For BMO, the main benefit and where we have sat within the industry is on financing and supporting these businesses throughout the life cycle of their employee ownership. So we're really focused on the commercial banking side, supporting their growth needs, supporting their employee benefit needs. But what's changing and evolving is with that, we also have a group Bank at Work within our institution that is really focused on financial literacy and education for employees. And the fact that employee-owned businesses care so much about their individual employees, it just really, financial literacy goes hand in hand with what ESOPs are focused on. So we're doing a lot more of education to the individual employees and doing a lot more education to the business owners, the selling shareholders, and helping them really make an educated decision on what's right for them and making sure that they know the good and the bad of all potential solutions so that they can make a truly educated decision.
Thanks, Leah. Do you have any final thoughts for business owners that might be listening to this podcast about what they should be thinking about when it comes to employee ownership plans?
So when I was thinking about this podcast, I was reminded of a heated discussion I had with my father-in-law years ago. The conversation was around which party is more important, the shareholders or the employees. And his argument was that if you don't have capital, then you don't have a business. To which I said, yes, but if you don't have employees, you also don't have a business. But in reality, you cannot downplay either group. But the beauty of employee ownership is that it makes those two groups one and the same. Your employees are your shareholders. So the interests of the employees are exactly the same interests of the shareholders. And so employee ownership, to me, really allows businesses and business owners to align their interests and focus and prioritize on what is right for their customers and for their communities.
Thanks so much, Leah, for joining us today.
Thank you very much for having me. It was a pleasure.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.